Welcome to Validea University. In this series of short videos, we will discuss some key investing concepts that impact investors today and distill them down into their most important components. In today's video, we will look at the price-to-book ratio and examine the arguments that it doesn't work anymore. The price-to-book has probably been the most important valuation ratio of the past century. It is widely used by value investors and measures a company's stock price relative to its book value, which is just its assets minus its liabilities. If you look at the academic research that supports value investing, you won't find any other ratio that is used more often. When Fama and French built their famous three-factor model, value was measured using the book to market, which is the inverse of the price to book, and much of the academic research since then has followed suit. Since many quantitative value funds and ETFs take their lead from the academic research, they have also relied more heavily on the price to book than any other valuation ratio. Over the long term, the price to book has worked. Although it has not performed as well as some of the other valuation metrics, it has produced a positive premium and has rewarded investors who have used it. But there has been a problem in the most recent decade. Value investing has certainly struggled in general over the period, but the price to book has struggled even more. This has led many to question whether the price to book still works and whether it should no longer be used to value stocks. Let's examine some of the arguments why the price to book may no longer work. The most significant argument against the price to book is that our economy has changed. While our economy used to be dominated by firms that have tangible assets like property, plants, and equipment, it is now dominated by firms with mostly intangible assets. To illustrate this, think about a technology company like Google. Most of its value is in its brand and its technology and its intellectual property. Valuing it using its physical assets like its buildings or its servers doesn't seem reasonable. Current estimates are that more than 80% of the assets in our economy are intangible. These assets do not show up in book value, and this makes price to book a far less useful ratio than it used to be. The second issue with price to book is that it can't handle firms with negative equity. Many high-quality firms have repurchased so much of their stock that they now have a negative book value. This makes it impossible to calculate a price to book for them and eliminates them from consideration, even though the activity they pursued to end up with negative equity was a positive one. The final issue with price to book is that it has negative quality embedded in it. What that means is that when you select the cheapest stocks using the price to book, you typically get companies with below average levels of quality. This is unlike other valuation metrics like price to earnings or price to cash flow, which have positive quality embedded in them. So is the price to book dead? It certainly has some major issues, and it is much more widely used than it should be given those issues, but the answer is it is impossible to say. Corey Hofstein from Newfound Research wrote a paper called Factor Fimbulwinter, where he looked at the amount of time it would take to say with statistical certainty that the price to book is dead, and he found that it would take longer than most investors' investing lifetimes. It is also important to understand that the fact that a factor hasn't worked in a decade doesn't tell you that it doesn't work over the long term, because there is a significant amount of noise in returns, even over a period as long as 10 years. So the struggles of the price to book in the past decade alone don't tell us it doesn't work. And if it bounces back in the next decade, that also won't tell us that it does. Another thing to keep in mind is that the cheapest stocks tend to have the least intangible assets. So the impact of not including intangible assets in valuing stocks is the lowest in the cheap stocks that a price to book strategy usually selects. So in the end, the question of whether the price to book is dead is one that doesn't have a definitive answer. It certainly has the strongest case against it of the major valuation metrics, but that doesn't mean it definitively won't continue to work going forward as it has over the long term. That concludes our look at the price to book. We appreciate you taking the time to watch the video. To find more of our Validea University videos, you can follow our Validea channel on YouTube. You can also follow us on Twitter at @GuruInvestor. To read our investment commentary, you can go to our blog at blog.validea.com. To take a free trial to our subscription product, which includes the 22+ factor models we run, you can go to our research website at www.validea.com. Thank you for watching.